So let's hop into the next level here in fundamental analysis. This is way cool stuff, way exciting stuff. Hopefully, to this point, you've had a few things click and you've said, wow, this makes sense. And there's some simple concepts here that are helping me understand how the investors look at stocks and look at value. And so this should be a really, really good time here. This should be really fun. So let's say that we did my financial statement, and let's just look at everything in my life. Okay, everything on Andy's financial statement. So we might have some assets down here. So what we would have is we would have, let's say, a book. Okay, and let's say we were going to write down all my assets in a book. Okay, so we'd start with some tangible things that we own. Maybe things that don't put money in the pocket, but things an account would still say is an asset. For example, my wife believes in the idea that diamonds are a girl's best friend. So you would take diamond earrings, diamond bracelets, diamond necklaces, and you'd say, there's some diamonds in our household. I have some gold, which is very tangible and also fungible, I might add. We have silver here. We have some stocks that we own. We have some real estate that we own. In my business, one of the things I sell is don't sell a lot of them, but I sell a book now and again. So I have an inventory of books that are for sale. And if people if people need a sleep aid, maybe that's a value, right? Don't read my books in the daytime unless you want a nap, and don't listen to the audio while you're driving. But we could look at not just the real estate that is producing cash. We could look at a personal residence, any cars that I own, all kinds of stuff. I mean, and the list would go on. And some of these produce income, and some of them don't. You could even have non-tangible assets like a brand, right? If the four pillars of investing is a cool way to describe this, or Andy's Mentor Club, there's brands. Are there any value in those brands? And those are non-tangible things. But at the end, we would have this, and we'd add all this up. We'd come with some type of number, right? Some type of number, whatever it might be. That would be the book value. Right? We'd say, hey, this is what we have on the books, and that's the value of what Andy has. So you would have that right there listed. Now let's say we took all of the income that we brought in. We have active income. So let's say I don't have much active income as far as things that require a lot of calories. For example, 2-3 times a year, I'll go out and I'll give a speech, and if I'm going to leave my family to go fly somewhere and take time off from the other things I want to do, I'm going to charge people for my time. And so I'm going to be aggressive in those speaking fees for sure, because it's taken me away, or whatever. So I'd have an active income. I'd have some portfolio income, as we talked about, and then we'd have some passive income from licenses or real estate income or whatever. And so we'd have all that. And you know what? We'd also have to list our expenses and our liabilities. So basically, that's all the things I have and the things I could earn, and you have the same thing. So you could list the same thing. Well, let's say that I wanted to raise some money right now. And I said, I'll tell you what, I own right now, if you took all this stuff and just put it in a circle like this, right now 100% of this stuff is mine. All the assets, all the liabilities, the good and the bad, all of the income and all of the expenses, the good and the bad, everything you see here's mine. I'll tell you what, I'll share half of it with you, 50% of it, and then I'll give you 50% of everything I have if you want to buy half of my life. So you would look at all this and say, would I want to own half of Andy's stuff? What's that worth? And would I want to receive from this day forward half of all this income And would I want to pay half of all these expenses and all these liabilities? You know, what it would be worth for me to pay Andy to get a share, a 50% share. So now you'd have your share and I'd have my share. But you'd have to give me some money up front for me to sell half of everything I have. That's exactly what stocks do. Is you might have a company like Coca-Cola and you just look at everything they have. You know, all the money they earn, all the expenses they have, all the liabilities, all their tangible stuff, all their intangible stuff, and you'd say, I'm going to give you some cash, some money, and I want a share of what you have. And so that's where these ratios come, is, you know, what would you be able to pay? And so the first, you know, price is the stock price, right? And you have the price per share of stock. And that'd be the number one, you know, and the price is what you'd pay, and the share of this stuff is what you get. So maybe you get 1 share, maybe you get 10 shares, maybe you get 1,000 shares. And so when Coca-Cola goes public, they divide this pie up into many, many, many shares, and you say, look, this is what people are willing to pay to own this stuff. So a really cool way to think about buying stock is to go deeper and not just say, well, I own a share of Coke, but say, you know what, I own a share of their income. I own a share of their expenses, their assets, liabilities, their cash flow, their equity. I own a share of all this stuff. And in the previous segment, we looked at that on the 10Q, or excuse me, the 10K, that finding the FCC, and it said, okay, this is your shareholder profits, right? This is your shareholder liabilities. This is your shareholder equity, right, of what you have as a person. So we could even break this down and say, well, you know, look at Andy. He gives a speech, and maybe I charge, I don't know, $10,000 to go somewhere and give a speech or something, right? And if you own half of that, that means you get 5 of it. So how much money would you pay to receive your share of those earnings every single year, or whatever, right? Whatever the business might be. You know, if there's sales of something, what would you pay to get some of those sales? All this stuff we listed on the value, you know, the book value, all those things we listed, those tangible assets, what would you pay for those? And what's interesting is it really comes down to what people are really wanting to get, is they want to get a cash flow, they want to get earnings coming towards them, they want money flowing towards them, and they want it to get bigger over time. And what you'll find is people look at a financial statement, no matter how many different ratios we can come up with and metrics, and we're going to get into the weeds of deep EBITDA and, you know, PEG ratios. We're going to get into that here in the 4 pillars of investing. But if you want to keep it simple, which I think we do, and you really want to take a bird's eye view, is as we look at this financial statement, what we'll really be impressed with is the amount of money it cranks out and its growth. You know, how fast is this growing and how fast is it likely to grow? Let's go out of theater mode here where I can back up a little bit. And remember, when we looked at Zion and LeBron, and please forgive the repetition, but I promised you I'd go back and hit things over and over and over again, is we had current production and potential. Those were the 2 things that we valued the most, current production and potential. When we look at a stock, we care about current production and potential. And what that current production often boils down to, you know, when you look at Benjamin Graham from the School of Value Investing, they're trying to find something's intrinsic value, its intrinsic worth. And so let's bring up Benjamin now, would be a good time to do this. Let's bring up Benjamin. And this is, you know, what they call the definitive book on value investing. You know, and I have a few highlights that I thought were interesting, but if we look right here at the at this, it says, look, there's a lot of different formulas, a lot of different methods and formulas to try to figure out if something's valuable or not. Okay, and this is a really important part of this book, in my opinion. And he says, our study of the various methods have led us to suggest a foreshortened and quite simple formula for the valuation of growth stocks, which is intended to produce figures fairly close to those resulting from more refined mathematical calculations. So basically, if I can take license to paraphrase, he says there's all kinds of formulas and all kinds of methods and all kinds of studies of these financial statements. Where can I get back? All kinds of studies in these financial statements, all kinds of ways people go about, trying to do this. And, we said that here, there's all kinds of different ways to try to find this value in this financial statement. And he says, after studying all the different ways people do it, right, our study of the various methods has led us to really suggest a foreshortened and simple formula for how these are values, which is intended to produce figures that are fairly close to all the fancy stuff. And here's the formula: earnings and growth. It just came back to that. How much money they're producing and how fast do we think they'll grow? And that's really what it is about LeBron and Zion as basketball players. What are they producing now, and what do they think will produce down the road? Zion is probably a pretty good pick. Now, he might break his ankle. He might tear his ACL. He might do a Len Bias. I don't think so. He seems like a good kid. But we don't know. We know what he produces now. We don't really know about the growth in the future. That one's more speculative. But even the great Benjamin Graham, boils this down to here. So, if you want to go to Warren Buffett's mentor, the guy that taught him how to do this, he says, look, you can go all the formulas you want, but look, earnings is a big deal and growth is a big deal. And so, we're going to look at a couple of different things. We're going to look at some metrics, and we're going to come down to some things that says, how much money do they make with what they have is going to be one thing we're going to ask. And we're going to ask about their earnings and growth. And we're going to find some metrics that make it about that simple. Now, granted, one of the things Benjamin Graham did do as he refined this is he did add something to this later on. He cared about the interest rate, which introduces the Federal Reserve, right? How available is money in a society? And so you look at an interest rate, maybe on bonds or whatever it is, and he would throw interest rate in here, which we will also care very much about. But nonetheless, the basics of this boil down to earnings and growth. I mean, that is really, what this is. He wrote another book called, Analyzing Securities or Security Analysis. Same formula. Later on, he added in the general idea of where interest rates were on bonds and different things. But basically, that's it. So what we're going to do now is just with that review, and that's really good always to come back to the basics of saying, look, there's price and there's value, right? There's price and there's value. What are you going to pay for this player, and what are you going to pay for what you get? Well, if you're buying the financial statement and you're going to say, look, I'm going to get a share of these earnings, I'm going to get a share of these assets, and I'm also going to get a share of anything that happens in the future if it grows or if it falls. I'm going to get a part of that. It belongs to me. So if we're going to take that attitude that we're really purchasing the items that are owned on the financial statement, you're purchasing the income that comes from them, and you're purchasing the overall growth, we want to get really, really good at understanding those numbers in financial statements. So with that, let's move forward and talk about some differences. We've done a lot with financial statements on this basic level, personal, your personal financial statement. We've done a lot now looking at Blockbuster and Netflix, and we looked at GameStop in terms of some of the stuff. Let's dive deeper and learn about corporate financial statements. So there's three parts to a corporate financial statement, and the one we're going to introduce now is we've already introduced profit and loss. We've already introduced the balance sheet. The one we did not look at that were involved in those 10 Qs, we didn't look at them, and we could, are the statement of cash flow. And the statement of cash flow is better taught by Tom Wheelwright, I believe, than by me. So your accountant will understand this, but you don't need to be an accountant. We just want to be able to speak to our accountant and kind of know what they're talking about a little bit. So we're going to talk about the statement of cash flow. Now notice that cash flow is simply watching how much comes in and out. So think of currency as a river, like a current or an electric current. And we can measure an electric current in voltage and amperage. We can measure current. We can measure a river in the amount of water that goes through it and the speed at which that water is moving. Niagara Falls has a lot of water current going through it, a lot of volume, a lot of speed. Maybe another Mississippi River has tons of volume but less speed, maybe. Stuff like that. And so yeah, we look at cash in and cash out. This is much different than earnings, income, the bottom line profit. Those are all the same numbers as we discussed before. And so when you buy a company, you're very interested in how much it earns. You're a little bit interested in how much it's worth, less so, but you're interested in seeing how the cash flows. And you can see that they're interested in three kinds of transactions here. These are transactions. So what causes cash to flow? Transactions do. If I sell a product, that's a transaction and cash moves. If I buy a product, that's a transaction and cash moves. So transactions make money move. Let me say that again. Transactions make money move. If you go out to the grocery store and you buy something, money just moved. If you go to a job and they give you a paycheck, money just moved. So these transactions are what make money move around. And they say, look, let's just analyze three types of transactions that can make money move. And this actually makes a ton of sense if we think it through. And this is not going to be, this is a primer. This is a basic class in fundamental analysis. This is not designed to go get you a master's degree in accounting. And this is a way of thinking about things. And if you're already an accountant, I take a little license here for simplicity. Please forgive me. But I think what we're teaching here and explaining here is beneficial to someone. So cash is an asset. So if you were to look at the assets, you might have stock in here, and you might have inventory in here that you consider an asset. You might have machinery that you consider an asset. I should write those more neatly. You might have stocks. You might have inventory. You might have equipment. Right? And you might have cash. And cash, where does that hold? Well, it might be held in a safe. It might be held under your mattress. But it might be held in a bank account, which is usually where cash and equivalents hang out, is in a bank account. So what if you pulled just the bank account? We didn't worry about the stock, and we didn't worry about the real estate. We just took the cash part of your assets and we pulled it out and separated it here. We'd notice something. We'd say, if we make a sale in our business, cash would come in. And if we were, and cash would come in to this box. And if we paid a salary, cash would go out of this box. So we could really say that, we could really say this, that income, right? Income puts cash in to the bank account, right? But expenses would pull cash out of the bank account. And this would be one type of cash flow. Okay? Now that would be one kind of cash flow. And we call this operational cash flow because operations, marketing would be an expense. Salaries would be an expense. Sales would be an income, right? Someone maybe we have a bill that they owe us, and we sold them some stuff a long time ago. They haven't paid for it. Okay, so they pay it and cash comes in. So a business owner likes to keep track of their operations. You'll notice that if we were to go back to that 10Q, it said statement of operations, right? Operations. And the profit and loss were from the operations. And so cash is going to come in and cash is going to come out. Okay, now think about this. What if we sold stock? Well, if we sold stock, that's not an expense, and it's not really income from operations, but it would convert, it would change the stock into cash and add cash here, right? And if we bought stock, well, if we buy stock, that's not money leaving the company, it's just changing what it is. It's more of a conversion. So a sale of stock would put cash into the cash box, but what if I buy stock? Okay, what if I buy stock? Well, if I buy stock, that would take cash out of the cash box, but it would add an asset. So, when you look at investment cash flow, we're going to, maybe the word, I don't know if an accountant would agree with me, but I would like the word convert. That I might have moved stock into cash or cash into stock, if that makes sense. So if I change, if I make a transaction that takes an asset into cash or cash into an asset, that's going to change the level of cash out of my bank account. And, this is just cash in, cash out. That's it. So if you sell an asset, cash would come in. If you buy an asset, cash would go out. Now, the net worth would probably stay the same immediately because, okay, I have $1,000 in stock or I have $1,000 in cash. It's still $1,000 either way. But it does show the cash flow going in from the sale of an investment or the cash going out of an account due to a sale of an investment or a purchase of investment. Now, the same thing happens here with liabilities. When let's say that I have a HELOC on my house, okay, or a HELOC on my rental houses, okay, and that credibility is about, now that's not a liability to me. Remember, that's part of my buying power number. It's only a liability if I use it. So I might go write a check to myself that draws from one of those HELOCs. That would put cash in. So the debt, right, would put cash in to the account, right? But maybe I already had a liability and I wanted to pay it off. So I make a payment on that debt to reduce the debt. Well, that would be cash out. And so we have three statements of cash flow. We have operational cash flow that shows money coming in and money coming out, the cash being moved that way. We have investment cash flow of assets being bought and assets being sold. And as you buy an asset or sell an asset, that affects your cash flow. And then we have debt where we borrow money, right, which brings cash in, right? And then we pay back money, payment. We make a payment which takes cash out. And so those are the statements of cash flow. Operational cash flow, right, which has to do with this, okay? Operational cash flow, which has to do with this. Investment cash flow, which has to do with this. And then finally we have financial cash flow, which has to do with this. And so it begins to make a little bit of sense. Now, that's new for many people. And it's probably not as perfect as an accounting teacher would share it. But the way my brain has worked, it seems to, that vision of it seems to have served me well. And at least I can semi-communicate with an accountant. That accounting stuff gets freaking hairy. And that's why you have a controller in a company that's paid a lot of money, because there's something called accounting practices. And when you learn accounting practices, you learn how much leeway you get in what counts as what. And we have something called creative accounting. Tom often says, how do you tell a good accountant? And I say, how? He says, well, what's 2 plus 2? I say, 4. He goes, nope. I go, well, then what is 2 what 2? He goes, well, what would you like it to be? And he doesn't say that in terms of ever breaking the law or not being accurate. It's just that, there's a lot of different ways to account for things. There's accrual accounting and there's cash accounting. Both are accurate and both are true. It just looks at it from a different angle and just counts things a different way. And as long as you're consistent, there's things called deferred revenue. Well, what is deferred revenue and how does it count and how does it not? So I don't get into all those weeds because that's why we pay accountants and attorneys to get into those weeds for us. Nonetheless, it helps us being the captain of the ship, it helps us being the captain of the ship to have a basic understanding of this stuff where we can say, okay, I get the general idea that operational cash flow shows the money going in and out of a cash account for operations. And I basically understand investment cash flow is money that's coming in and out based on the assets that I buy or sell. And that financial cash flow is just keeping track of how much money goes in and out of my account based on the money I borrow and based on the money I pay back. And that would be a good basic way to begin to think about it. And if you want to get more advanced and take an accounting course and get into those weeds, you could. But I like keeping things simple, and this seems to have served me well, and I hope it serves you well too. So let's just take a look at this very quickly, and this will be crude. I'm sure a professional accountant will just cringe, but we're just looking at concepts here, okay? There's so many different ways to account for things. We'll just look at some concepts here. So let's just look at it basically this way, that if you borrowed money to start a business, there's a couple ways you could raise capital to start a business. Number one is you could say, hey, I have a great idea here. I think I can do great operations. I think I can bake cookies or whatever. I think I could probably buy them for $1 and sell them for $3. And you convince someone that that's true. They would either loan you money in this case, or maybe they say, hey, I'll give you money, but I want to share your company. And you'd have to decide if you wanted to give them equity or just give them debt. That's the bond is the debt, or a share is an equity. So notice that there was no money made, but cash did flow. There was a transaction that occurred. This guy hands you, and there's an inflow of cash into your account. Now, that's not income, that's inflow. This is inflow from a loan. So the cash flow is a positive $125 into your bank account. Let's just say it that way. Okay? And here we have another transaction. We say, all right, let's take this money and buy some cookies and bake them. So now we wind up with 125 units, about $1 a piece. Okay? And so very, very simple. Notice that we haven't earned any money yet. We make a sale for the first time, and they buy 100 units. So that leaves us 25 units in our inventory. They take 100 units, and we get $3 a cookie. And let's say they give us $100 now and promise $200 later. And that might be cool if we're the cookie factory and they're the bakery. They'll say, hey, we'll give you the others when we sell these cookies or whatever. So that's great. And so we have accounts receivable 200. Now notice we earned $200, but now our cash flow is positive 100. So as we look at cash going in and out, we have a cash flow of 100. But as we look at the money we made, it's $200. Now, if these guys welch on the accounts receivable, we won't sell to them anymore, and we'll have to do a revision on our profits, right? But our cash flow is still, we got $100 in there. So we might not, we might have to revise this later. Say, well, they promised, so we thought we earned 200, but we didn't. We only got 100. So, and then we, adjust the statement. But you get the idea that cash flow is different than earnings. And maybe we decide to pay the loan, so that's another cash flow. Well, it doesn't affect our earnings. We just, paid money back. So cash flow and earnings are different things. Now, why do I take you through this crude example of cookies? Well, 2 or 3 reasons. Number one is your accountant would get way more in the weeds on this than they. And there's a lot of different ways to account. There's accrual, there's cash, there's, what do you count? And accountants have what they call accounting practices. What counts as deferred revenue and when you can pull deferred revenue off. And there's all kinds of weeds and complex things. at the level we're at, just a primer, the thing I would hope for is that you just say, look, I know that these are different. I know there's operational investment and financial transactions that go on, and we're going to track those separately. But the big reason for this particular, crude example is magic. Is where does the magic happen? And the magic happens here. Yeah, we want to know that you can pay a bill or get financing, and yeah, taxes will come, and we know what that is, and all this stuff. But can you make money? There's magic here. So often what investors will do, and they demand this from accountants, is they'll separate operational cash flow or operational stuff from all the other stuff. Let me explain. Yeah, corporate, everyone pays taxes. That doesn't make anybody special that they pay taxes. And yeah, they're going to pay interest to the bank. Well, that doesn't make anyone special to pay interest to the bank. There's no magic here. It's just part of regular business. How can I tell if this is really a thriving business that's really, really cool? Well, I certainly care about the total income that comes after, all this tax and, run-of-the-mill stuff. But I'm really interested in the operating income, right? Before we pay all this stuff and before all this other normal stuff happens, hey, where's the magic, right? How's their operations? And so in both real estate and stocks, we tend to separate that out sometimes. And we say, yeah, I'm very interested in the total net income, and I'm very interested in the total net income, which we call earnings. And we're also interested, though, in what we call the NOI, the net operating income. In other words, yeah, I know you got to pay your payment to the bank, but I'm interested in how much rent do you get? You have laundry that you make money on, parking, and how's the management, and how much do you spend on maintaining this thing and advertising? These are called non-capital expenses. If I go put in a new air conditioner, that's not regular operations. That air conditioner might last for 10 years. If I go and paint something, that paint might last for 10 years. So those aren't regular run-of-the-mill stuff. Those are improvements. So I want to know how they operate. Well, we have the same thing here with something called earnings before interest. How much money do you make before they look at interest and taxes and depreciation? Before all this other stuff, how do your operations do? How many sales do you make? Do you have money from service and fees that come in? Is your payroll out of control? How much money you put in research and development, whatever? And so you have operational expenses and operational income, and then you have non-operational expenses, if that makes sense. And so like a debt payment or taxes, stuff like that. So making it fun, simple, real, I have some investments, and everyone thinks that, oh, they have to be the best and they have to be this. And I'd say most of the time I think Buffett and my investing friends have great investments, but maybe you just need good ones, right? It'd be nice to have the best ones every time. But I'll show you some investments that I have, because it's got to be fun, simple, and real. I'm always hesitant to do this type of stuff because it's very personal, but I think it's worth it, because people appreciate real stuff, and it's hard to translate what is in a class sometimes to what it really looks like on a real, like what does a real financial statement look like, because they're kind of complex, right? When you go from something real simple like this graph right here, or simple from cookies, or a simple thing, what does it look like in real life? So let's start with this one. This is an apartment complex. It's got 185 residential units and then 4 businesses in the bottom in Dallas, Texas, Dallas-Fort Worth area. And it's fun because, when we go to Dallas to watch the Dallas Cowboys play on Thanksgiving, play the Redskins, and, we can take a little time off of the game and drop in and, tour the property and see how the investment's going with our boys. So it's fun to have these financial lessons that are very tangible and very real. So I called the one of the sponsors of this deal, and I asked if I could use this for an example in the class, and they granted me permission to do this. And so you can see here, let's get rid of this. I'll bring up one, and all we're really going to look for is this number, net operating income. How do you find that number in a real statement? Well, you can see that this statement here, it's got what, 125 pages to it. It's a monthly thing that I get every month as an owner, um, partial owner with many, many other investors. And if you look at this here, it shows in the table of contents that, there's all the things that someone would want to know. I mean, we have the ledger and we have the checking account, the whole thing. But look at this here. We got an income statement, a balance sheet, and a statement of cash flow, just like we've been talking about. Income statement, balance sheet, statement of cash flow. So let's just look at an income statement right here. And what I'm really looking for is here's all the income, and you go through, and all of a sudden, bam, you see, look at this, net operating income. And that's the number I want to see get big. If we can blow this up a little bit, I see net operating income. Where'd it go? Right here. And so this had a net operating income of $105,000, and the year to date is about $700,000. That makes sense, because if this is in June, then it's about $100,000, a little more than $100,000 a month in net operating income. This separates out, painting and improvements to the property. This is what the operations bring in before debt service and all the other stuff. Now, the reason this is important is, you'll see, is this is what a bank would most likely look at to say, should we loan these guys money? Because it's this money that allows us to pay back a loan, if that makes sense. It's this amount of money that really lets the company do things, that lets this rental property do stuff. And so if a bank comes to them and says, well, if they go to a bank and say, we'd like to refinance this property, we'd like to borrow money from it, they're going to, we'd like to get rid of our own loan and get a new one. They'll say, well, can you pay back this loan? What's your net operating income? And that's often why they'll separate that out from the total income, because you might be refinancing the debt service. This number here, let's bring this back up. This number of debt payment might not even matter, because you're refinancing it. This debt payment's going to go away and be replaced with a new one. So if this is going to go away in the first place, well, let's just look at what the net operating income is. And so that's an example of finding it. And there's a lot of stuff to look at. So when someone is overwhelmed with pages and pages and pages of numbers, if you can say, okay, what am I looking for? Well, there it is, net operating income. I got it. And so if you know what you're looking for, it becomes really, 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 really simple. And these are great educations. Well, what's a non-operating expense? And you start to read these things, and you begin to learn more about how companies work by looking and studying their financial statements. So that's an example of one. Now, we said that in stocks, we like to know this number called EBITDA. And it's a very similar idea to net operating income. What does this thing make before all this silly, well, it's not silly, but crazy stuff? So here's a company, and notice that their EBITDA has been falling drastically. I mean, look at this. The money they're making from basic operations is falling. So for me, this is a shorting opportunity. And there's many, many websites. If you're in the coaching program, they can turn you on to a few. I got this report from Finbox. I thought I'd just bring this up quick, because I brought up a real one from real estate. We'll bring up a real one for stocks. So there's Apple. We could change this. Here's the EBITDA. Apple's is on the rise where GameStop's was on the decline. And what's fun is they'll even let you compare apples to apples here. They'll say, well, here's Apple's EBITDA. Here's what the average in the sector is, and here's the NYSE. So sector IT, and they still have them in information technology. I think they're more of a retailer now, but you say, well, how do they compare to Adobe or Western Digital Hard Drives or Costco Wholesale or Dell Technologies or Facebook? How does their EBITDA compare? And of course, they're dwarfing these guys. So it's nice to compare apples to apples. So when I look for a real estate investment, maybe one of the questions I ask before I invest is, well, what is your net operating income? And I can compare that to other 185 unit apartment buildings, right? I can compare it and decide, well, is this net income stronger than another? Does it have potential for growth? Remember those two things Benjamin Graham said is, can this number grow? And so if I'm looking at a stock, I'm going to say, well, does the EBITDA look poised to grow? That's what it's doing now. What's its potential? And right here, the question I always ask is, okay, so how are you going to grow this net operating income? How are you going to make that bigger? And they're going to have to come with a plan of how that works. And as an investor, I have to say, well, I think that's a viable plan or no. So net operating income on the real estate side, EBITDA might be a nice way to look at that on a stock side. But the essence of the fundamentals is still the same, right? It's really an operational number either way. So that's kind of fun stuff. So the way to look at this then is you look at assets as a money machine. So right here we have a grocery store, we have an oil well, we have rent, we have, Acme, and we just should look at these really click as things that crank out cash. This is really nice because I think it helps people get out of the trap of, rooting for their asset class. I'm a businessman, so it's better than commodities and oil wells. And, well, I'm a stock guy, and that's better than real estate, or real estate's better than stock. Look, they all just create money at the end of the day. And a fundamental analyst would look at that and say, look, how do they produce their cash? How solid is this cash production? How much money does this money machine make? And how solid is this particular money machine? Because you know what? There's probably some oil wells that are better than a lot of houses. And there's probably a lot of houses that are better than a lot of oil wells. There's probably a lot of real estate that might cash flow better than stock. There might be stock that cash flow better. It's just pictured as a money machine for as far as fundamentals go. And of course they're different. Of course they're not totally homogeneous. But it's a good way to understand fundamental analysis. So the question is how much do you pay for this money machine? And going back to Benjamin Graham, going back to Warren Buffett, the value investors, what is this money machine? Well, how much does it earn? What comes into this bucket? Right? How much comes into this bucket? And, what are the earnings here? How much comes into this bucket? And so now when I decide to look at different investments, I can say, okay, on one side I have the price, and on the other side I have the earnings. I can begin to pair those two to see if I can find some value, right? So here, the price of this money machine, whether it be a stock or an oil well or a business or whatever, this thing, whether it be real estate, stock, whatever, is generating $10,000 a year. And if I buy this, I get a share in that $10,000 a year. So what's the price of this money machine? Well, it's $200,000. So I think, gee whiz, if I want to put money to work for me, I put in $200. Now I have a $10,000 income, and in 20 years it'd pay for itself, and in 40 years I'd really be doing well, right? But I also have to figure the growth. What if this turns into $100,000 someday, or $300,000 someday? I got a great buy on it. Over here, this one, the price for this money machine is $100,000, but it only generates $4,000. So which is better, the lower price or the higher price stock? We can probably do that math in your head. A lot of people would say, well, I'd rather have this because it's cheaper. And it's kind of how people shop. Well, this is cheaper. This is cheaper gas. This is cheaper food. This is cheaper medical care. This is a cheaper flight. But they often don't consider, well, with that cheapness, there's a saying that says you get what you pay for. Maybe the reason this is $200,000 is this generates more money, right? And so we want to look at what's called return on investment. There's the investment. What's going to be our return? Well, here the return on investment is 5%. We're going to pay out $200,000, and we're going to receive $10,000 a year on this, at least at what it did in this year. Okay, over here, our investment is, return on investment is 4%. We paid $100,000 a year. So even though this one's cheaper, this one that's more expensive is the better return and the more effective machine for what it costs. And so value investing isn't about finding low prices. Value investing is finding out, is what you get here better than what you get over here, dollar per dollar. And here it's 5%, and here it's 4%. You could flip this over. Notice how it's the same ratio. You can flip this over and you can say this a different way. You're paying $20 to make $1, right? If we do a little basic math and we say, you know, let's take off 1, 2, 3, 4 zeros, 1, 2, 3, 4 zeros. Now we have a 20-to-1 ratio. Might be a way to do that. Well, look, I'm going to pay 20 to make $1 that way. You could do it that way if you wanted. Over here, we have the same idea. I should put this in theater mode because we don't need to write that much on that. And so you're paying $25 to make $1 over here. So the way that we would calculate this if this were a real estate investment is we'd say, well, you know, what's the NOI? And we'd say the price, right, and the NOI put together would be what rate am I capitalizing? In other words, what is the rate of return on my capital? So they have this fancy jargon called the capitalization rate. But it's really just a way to say, look, you're going to make 5% on this property. And that's what they do with the NOI. Now understand that this does not include debt payments, doesn't include all this stuff. A cap rate doesn't include everything. It's just the what? Net operating income, and the price tells you what the cap rate is. Doesn't mean you're going to get all that money because there are other things, you know, the payments, the taxes, the non-capital expenditures, stuff like that. But this is a great baseline for basic, you know, return on investment. Over here, our capitalization rate would be 4. And so this is why they look at it if it is real estate. This is really funny. It's kind of a quirky thing that real estate investors like to look at it that way. They like to say, okay, my cap rate is 4%, or my cap rate is 5%, or you know, whatever it is. They use it with the NOI on top and the price on the bottom. So cap rate is NOI divided by the price. That's how you get that number. So I'm not a professional real estate investor per se. I have some, and I have these reports that I read, and I have single-family homes that I rent as well as syndications. But it's important, I think, to, as a fundamental analyst, at least have a basic grasp of those numbers as I invest and learn as you do. Okay, so right here, if this were stock, and notice the machine is just changed into stock, the numbers are the same. If it were stock, you wouldn't use a cap rate, you'd use something called a PE ratio, but it's the same number. Here, we just flip the price on the top and the earnings, and we call this a PE ratio, a ratio of the price to the earnings. So it's very much like a cap rate in you know, we have the same ratio. Here we're paying $200,000 and getting $10,000 back, and here we're paying $200,000 and getting $10,000 back. The only difference is you know, in real estate they talk about the income and then the price, and in stocks they talk about the price and then the earnings. Right? It's the same type of idea. One little nuance here is notice that when you look at price to NOI, that's not EBITDA. That's before all this stuff. When you look at stock, this is not an EBITDA number. This is a bottom line number. So this is an actual, you know, end of line number. But it's just good. I think these are really good comparisons. That look, what am I paying for what I'm getting? What am I paying for what I'm getting? So they are slightly different. They're not exactly equivalent. You know, price over EBITDA might be a little bit better metric to make a perfect comparison, which is why we like EBITDA. So this graph isn't, you know, exactly perfect because one is, you know, the S&P would be earnings, end of the deal. Here's the cap rate, which is just NOI, which doesn't account for all the expenses. But you can see that it's interesting because the numbers are flipped. You know, when stocks are here, this is here, and you know they're inverted. This is inversely correlated. Why? Well, because they invert the number when they do this. That's less important than just understanding that this is a machine, and these are two numbers: price, what I pay, and understanding what I get. Goes back to that Benjamin Graham formula of earnings, and we'll talk about growth here in a bit. So let's look at something called a market cap and an enterprise value. I'm going to check our time and see how we've done. Maybe this is the end of a segment. We'll see. Looks like we've got about another 10 minutes before we hit an hour. So let's see if we can get through 10 more minutes of this before we do another segment. Fun stuff. So another way to look at value is, what's the whole thing worth? And so if you look at the number of shares in the pie, here's an example of a stock that's got, 4 billion shares out there. So they cut this pie up pretty big, and the price is 203 as of this recording. And so that gives it a market cap of almost $1 trillion. And someone says that sounds maybe like, Apple Computer might have been there at some point in time. That'd be a very good guess. The enterprise value is a little different. It doesn't just take the price times the number of shares. It says, well, what are you actually getting with the business? Well, certainly you look at the market cap, but how much debt do they owe? And, how much preferred equity is there? And do they have pension stuff and cash and short-term investments? So they put together a bunch of this stuff and they say, well, we'd say the enterprise value is a little less than the market cap because of some of the other stuff. So I really like enterprise value better than just market cap because I think it is a more accurate representation of what's actually in the balance sheet in assets and liabilities. So in the 4 pillars investing class, we show both market cap and enterprise value. And when we run searches for stocks, we like a large cap, so we look at this in what we search for. But once we start narrowing it down, we say, well, what is the enterprise value, and how does that compare to how much they make? It's funny. This is the value of the machine, and how much money does that machine make? So here we can compare enterprise value to EBITDA, and so this helps answer these questions. Is the enterprise value really tells us what we're getting, right? What we're actually getting, and EBITDA tells us before they pull out a bunch of, amortization. We talked about this number, is how much the earnings they're bringing in. So that's kind of cool, right? This shows us the machinery and what they have, and this shows us what they can make with what they have. Pretty cool, right? This shows us what they have and what they owe, and this shows us what they bring in and what they spend from what they have. So it's pretty cool to think of it that way. And these are just what some investors feel are just a little bit more accurate earnings type of numbers, And we can do this. Of course, this was Apple that we were showing, and we're showing that their enterprise value compared to their EBITDA is on the rise here, and they have an enterprise value over EBITDA of 12.5. That would be the number. So now we're going to get down to, well, maybe what we got to do is we'll finish that idea right there, and let's just do a quick review of what we've learned about. We've learned about earnings. We've learned about cash flow in this segment. We've learned about enterprise value, net operating income. This is a very rich segment we're completing, a very rich segment. And the reason that we do this on video is the downside is I have to redo them every 5 or 6 years probably, just to put in new stuff and updated stuff. The principles won't change at all. But the advantage of doing it by video is you can review, because if I taught this class live and you didn't catch everything, how do you take it again? And there's enough numbers here that it's probably difficult in a 1-hour segment to remember everything because it's so dense and so rich. So understand the big picture concepts. What is value? Well, it's what do you do now? Think of LeBron James. What does he do now, and what's his potential? And think of Benjamin Graham. What does it do now? What is the potential? So now that we've got this basic idea of just some very basic metrics that have to do with earnings and have to do with growth, let's start looking at criteria that's usable to make this not just fun and simple, but to start to make it real. And in this next segment, let's start looking at the criteria, right? So is this a good number or a bad number? I understand the number. It tells me their enterprise value, and it tells me how much they made, but is that good? You know, is this a good number? Is it a bad number? So in the next segment, we're going to start to divulge and start to pull back the curtain on what makes for a good number and how do I decide what a good number is. Oh, we're going to hop in. Oh, it's so fun to do the very best we can to make this stuff simple, and so people can have epiphany after epiphany. It's like, okay, I'm starting to understand this. This is probably one you review. No homework yet, but we'll be getting you ready to get with your coaches, get a little homework done.